Okay, students, welcome to the class. Okay, so we did complete our discussion, right? So let's quickly do a quick recap. Let's do a quick recap of what we did in the last class and then move forward today, right? So today, the main focus of our discussion will be credit multiplier, which is a very important and interesting topic within banking and money market because that helps us understand how do banks operate, right? So that will be very interesting and eye-opening for you, right? Which we'll come to in a bit, right? But let's quickly do a quick recap of what we did in the last class, and that was liquidity preference theory, right? So that is one of the two theories that are part of our syllabus that help us understand that how interest rates are determined in a country, in an economy, right? So liquidity preference theory, as I said, is developed by Keynesian economists, and this is a little, outdated, you can say, or older theory, right? Liquidity preference theory says that interest rates in a country are determined by demand for money, right, and supply for money. So according to this theory, demand for money is based on three motives or three factors, right? So transactional motive, which is basically the reason why people want to hold cash to make their day-to-day transactions, right? Whatever they want to buy and so on and so forth, right? So that is transactional motive. Then another motive they have is precautionary motive, right? Precautionary motive says that people always carry some extra cash than what they need, because that is what precautionary motive is. And then the third and the last is speculative motive, which is basically either you can hold your savings in cash form or you can put your savings in a bank account, right? If interest rates in the bank are high, you put your money in the bank account. If your interest rates are not very high, which means that you are not getting good return on savings in the bank, then you prefer to hold your cash. Then you prefer to hold your savings in cash form, right? So these are the three motives why people want to hold cash. Now for the transactionary motive, if you remember, and for the precautionary motive, we said that these are active balances. Now what do we mean when we say these are active balances? This means that this amount is expected to be used in near future. Active balance means that this amount of money is expected to be used in near future, and these are regardless of the interest rates. Now, if you remember, we talked about this a lot yesterday, right? So let's move to that and discuss that, right? So, but before that, let me write it down over here. This is active balance. This means that it will be most probably used in the near future, right? So this money is for transactions, and obviously that is to be used. Then same goes for precautionary motive. That is also an active balance. This means that you plan to use it in the near future, right? And then the third and the last one is known as precautionary. This is known as idle balance. Speculative motive is known as idle balance. Why? Because this is your saving. This is an individual savings, and they can either hold their saving in the cash form or they can put their savings in a bank account if the interest rates are high. Okay. Now, another thing that we looked at in this theory was the graphs. So the graphs for each of the three types of each of the three motives for demand for money, we looked at the graphs. Let me draw smaller graphs on top of this, right? So first one, for the transactional motive, it will be a straight vertical line. Why would that be the case? So on the y-axis, you have interest rate. On the x-axis, you have quantity of money, and it will be straight horizontal line, and that is known as perfectly inelastic demand. Why? Because no matter what the interest rate is prevailing in the economy, you would hold just enough cash. You would hold just enough cash that you need to make your transactions, right? Right. I'll let you know about towards the end of the class, right? So you will hold just enough cash. You'll hold just enough cash that you need for your transaction, right? So if let's say someone every day needs 1,000 rupees or 2,000 rupees, then they will only hold that amount, right? And that is regardless of whether interest rates are high or more, because as I was telling you yesterday, think about this. If I need 1,000 rupees daily to buy my food, to pay for my expenses, to pay for my fuel, then I will need to carry this money with me every day, no matter whether the bank's interest rates are going up or down, right? And similarly, for the precautionary motive, again, it is an active balance and it is perfectly inelastic demand, with regards to interest rates, perfectly inelastic demand of money with regards to interest rate, which means that if you want to hold 500 rupees as precaution. If an individual wants to hold 500 rupees as precaution, just in case, he or she needs to spend that money, right? So that would be your precautionary motive, right? And that is also regardless of your interest rate. When the interest rate is more, 2%, 4%, 6%, whatever it is, that is, you will always hold this amount of cash or money, right? Then comes in the third and the last type, which is speculative motive. Now, the graph for speculative motive is quite different from the other two. Why so? Because this is dependent. Demand for speculative motive is dependent on interest rates. So if interest rates are high, you would want to put your money in a bank account. If your interest rates are low, then you will want to hold your savings in cash form rather than putting it in a bank. Okay, now let's look at the graph. So these two that I've just made over here. So you can say this is transactionary motive, right? Transactionary motive. And then the other one that I made was for precautionary motive, right? Precautionary. And the third and the last one that we're about to look at is known as speculative motive, right? So the demand curve for the speculative motive would be a downward sloping one. The demand curve for speculative motive is downward sloping. Why? Because if interest rates are high, you'll want to hold less in the form of cash. Why? Because the remaining is being deposited in a bank. So if interest rates are high, have a look at this ones. So if interest rates are high, let's say 7% or whatever it is, right? Then you are holding less of your savings in the cash form. You are holding less of your savings in the cash form and putting more of it in a bank. But if interest rates are low, then you don't have much incentives to put your money in a bank account, and therefore you might prefer to hold your savings in the form of cash, right? Is it simple? And now comes in looking at the overall demand curve for money, right? In that case, it would look like this, right? In that case, it would look like just like the graph that we have made for speculative motive, right? So the demand for money would look like, okay, have a look at this. So here we go, right? So the demand for money would look like speculative motive, and it will be a downward sloping curve. Overall shape of demand for money will be downward sloping curve, like we made for the speculative motive, right? So on the x-axis, you will have quantity of money, and this is what the demand for money. So demand for money would look like DM, right? Easy. Are we good on this? Okay. Now, what is the other thing that we need to add to this? What is the other thing that we need to add to this? Okay. And that is supply of money, right? That is supply of money. Excellent. And supply is fixed. Very good. Excellent. Isha, right? Supply, and that is fixed. Why? Because supply, according to this model, supply is determined by the central bank. Supply is determined by the central bank. So during a certain time period, think about this. So when we say money, it is the currency notes that we're talking about. So it is the currency notes that we're talking about, and during any particular point in time. So if you think of Pakistan, at this very moment, there is a certain amount of money that is in circulation. Obviously, we can count it, right? So how much money is lying in the bank, or how much money is lying in the wallets of Pakistanis, right? So that would be, let's say, a certain amount, let's say 350 billion rupees or whatever it is, right? So on. So we can count that, but that is fixed at one particular instance. Right now, obviously over time the supply increases, but at one particular instance the supply is fixed. So where the supply, according to liquidity preference theory, where the supply of money intersects with the demand for money, that is the equilibrium interest rates. That is the equilibrium interest rates, right? Now, as far as the questions in past papers are concerned, so this theory is more tested compared to loanable funds theory. So we'll do some questions, right? And if you're having a class tomorrow, we can perhaps look at one of the, but I don't think so it would be a good idea. So let's complete up with the syllabus first, because we are a little lagging over there, and then we'll do this together. But the questions are very simple and straightforward. So sometimes questions say that what are the motives for people holding cash? What does liquidity preference theory says about interest rate determination? Like very, very straightforward, right? So as long as you know what are the three motives, what their graphs look like, how does the demand curve for money looks like, which is downward sloping curve, and how the supply curve of money look like, which is a straight vertical line. And the reason for that, because money supply is controlled by the central bank of the country, and that is fixed during certain time period. Money supply is controlled by central bank of the economy, and that is fixed during certain time period. Controlled by central bank, right? Okay, so as long as you know all these things, you are good. Okay, now today we are starting off with a new component, which is again very important, and you will see some questions in the past paper. That is credit multiplier. Now let me set the basis of what exactly is credit multiplier, how that works, what we are about to discuss, and all these things. Okay, now students, let's start off with simple but interesting question, right? So the simple and interesting question is, think about this. So if you remember, in the last few classes, I told you the basic mechanism, which you would know already. Think about this. The way a bank operates is that bank is an intermediary. Bank is an intermediary that connects two types of people in the economy, right? So people who are savers or depositors, as we say. So these are the people who save a certain money every month, right? So if they are employed somewhere, so most probably they will be saving their money every month. So perfect example of that could be, right, if someone earns 50,000 rupees per month and they only spend 30,000 rupees during a certain month, so they are saving the remaining 20,000, right? And on the other side, and the other type of customers for a bank are the borrowers. So these can be businesses, or these can be individuals who need to take money or borrow money from a bank because they want to invest in a business, or they want to buy something like a car or a house or something of the sort, right? So these are the two, depositors and borrowers. These are the two customers for a bank, right? And what bank actually does is that bank is just channeling their money, is channeling the money from the depositors to the borrowers. And then the way interest rate works is that if, let's say, bank is charging 10% interest to borrowers, then some portion of that is paid to, let's say, 6%, right? 6% of that is paid to depositors, and the remaining, the difference between the two, goes to bank's pocket. So that is how banks make profit out of it, right? As simple as that. Now, this being said, here comes interesting question. If, let's say, there's a certain bank, let's make example more interesting. So let's say there is this bank, this is a private commercial bank in Pakistan, HBL, Habib Bank Limited, right? So if, let's say, across all their branches in Pakistan, now listen to this question very carefully. If, let's say, Habib Bank, which has multiple, I mean, hundreds of branches, I guess, across Pakistan, has total amount of money deposited of 100 billion. Now listen to this very carefully. So if the total amount of deposits in Habib Bank Limited across Pakistan is 100 billion rupees, my question to you is, what is the maximum amount that HBL can issue in loans to its borrowers? Now, I'm not saying whether they will issue or they will not, but what is the maximum amount that they can issue to their borrowers? What is the maximum amount of loans? How much amount can they lend to borrowers? That's my question. If there's any confusion about, anything, you can ask me, right? अगर कोई चीज आपको समझ नहीं आई कि what do I mean, ये वाली बात आपको समझ में आई? So if there is a total of 100 million rupees deposited, obviously, let's say if I have an account in HBL, I save some money over there. Your parents have they have their account in HBL, or obviously so many other people. It's a big bank, right, in Pakistan. So if, let's assume that there is a total of 100 billion rupees deposited in HBL across different branches, the simple question is that what is the maximum amount of loans that HBL can offer to its borrowers? What is the maximum amount that it can offer to its borrowers? 15%, 25%. What about the remaining amount? What would they do with the remaining amount? Why would they not issue all of the 100 billion? Why is that a problem? Why is that a problem? Did you get my question? So, okay, if I, you know, take your example, right? What you're saying, 15%, 25%. So basically what you're saying is that they can only issue a proportion of their total deposits in lending, which is kind of understandable. But my question is that what they are keeping the remaining amount for? Why are they keeping the remaining amount and not lending the remaining amount? Reserves. Okay. Reserve for what? Reserve for what? Okay. Quickly, students, so it is a little bit of calculation that will take us some time. Reserve, so they're keeping the money reserved for what? Okay, so let me help you in this. So perhaps what you're trying to say is that if they issue 10%, now listen to this very carefully. So if they issue 10% of this in loans, which would be rupees, let's say, or let's say 15 or 25%, let's take 25%. So if you're saying that they can only issue 25% of this amount in loans, right? Then it would be, let's say they can issue 25 billion rupees in loans to its borrowers. Okay, that's very, sensible thing to say. Why? Because think about this, the remaining 75 billion. Now listen to me very carefully. The remaining 75% or remaining 75 billion rupees will be kept at HBL branches. The remaining amount will be kept at the bank in the form of cash, right? So that, right, if these people come and claim their money, and they, let's say, withdraw their amount, they can withdraw their amount anytime, right? Then obviously the bank should be able to honor its liabilities. The bank should be able to honor its liabilities, right? So think about it. If I have my money lying in a bank, right, 10,000, 15,000, whatever the amount is, 1 lakh rupees, let's say. I go to HBL, I take, I just want to withdraw cash because I have to give cash, 1 lakh cash to my friend or whatever, right? Now, if I go and the bank says, oh, we have issued your amount in loans to someone, I would not like it. I would not like it. Are you guys getting me? How this thing works, right? So the thing is, right, keeping money for depositors. That is what you meant, right? Arba, great, perfect. Isha, are you on the same page? Right? So long story short, when I asked you the question that if this is the total amount of deposits available to any private bank, what is the maximum amount that they can issue in loans? And Arbab said a proportion of it, right? Perhaps 15%, 25%, whatever, right? So that was a sensible thing to say. Why? Because if they issue 25% of that in loans, then remaining amount, 75 billion rupees, will be available at the bank in case depositors come and they want to withdraw their money, right? Because that is what the bank responsibility is, to return the money to depositors as and when they need, right? Okay, great. But how about I tell you the reality, right? This is what even I have thought for the longest until I came across this. The reality is, the truth is that a bank, right? Yeah, 100 billion is collected from depositors. Yeah. So think about this. Their salaries are coming in, they open their account, some people deposit their cash, right? So this is what I mean when I say deposits. So that is what I mean, right? So if my salary with whatever school or whatever organization I'm working in, and I have a bank account in HBL, every month I receive whatever salary, whatever my salary is. And similarly, some people go and deposit their cash because they are receiving their salaries in cash and so on. So that is what I meant when I said deposits. Okay, now students, now here's the thing. Now let me tell you how this thing works. So if the total deposits for a bank are 100 billion rupees, you won't believe me that a bank can issue loans up to, I'm not saying that they will actually issue, they can issue loans much more, or at the easiest, a bank can issue loans more than the amount of deposits that it has. A bank can issue loans more than the amount of deposits that it has. Now, this might be very surprising for some of you, like how is that even possible? There's not enough cash. How can you issue loans worth this much to, let's say, if I say 200 billion rupees. So against deposits of 100 billion rupees, if I say that this bank can issue loans up to 200 billion rupees. Now, this is something, weird, right? How is that even possible? Well, let me explain you this. And this is exactly what the great multiplier is about, right? Did you get my example? Do you want me to clear this board, right? So the only thing that I've said over here, the main part to remember, that banks, private banks can issue loans more than the amount of deposits that they have. Private banks can issue loans more than the amount of deposits that they have. That's what I'm saying over here. Now, how is that possible? That is what we're about to look at. And that is what credit multiplier explains. Okay, think about this. Now, students, you have to pay close attention, right? Now, the thing is, when a bank receives deposits, first of all, I'm explaining you the entire process, how this works. So as per the central bank, as per the central bank of the country, which is the State Bank of Pakistan in our case, commercial banks divide their deposits in two categories. I repeat, when banks receive deposits, when people come in any bank to deposit their money, or let's say money is transferred online or whatever it is, right? Banks split their deposits in two categories. One is known as liquidity ratio, right? What you were saying as reserves, right? Or let's use the word reserves, right? So one is known as reserves, right? I'll tell you what the purpose of that. And the second category would be known as amount available to issue loans. Amount available to issue loans. Students, is this clear so far? Right? So out of the total deposits that a bank has, it will split its deposits in two categories or two sections or groups or whatever you want to say. One category would be defined as reserves. You can also call this as liquidity ratio, because this is what we'll be using again and again. So this is liquidity ratio. Now, what is liquidity? Liquidity is basically ability to convert something into cash. Liquidity, according to accounting, means anything that can be easily converted into cash. So cash is the most liquid asset, because, I mean, by very definition, cash has to be the most liquid asset, because liquidity says the ability of an asset to be easily converted into cash. So bank deposits are very liquid, changing assets to cash. Isha, are you getting me? So liquidity is ability of an asset to be easily converted into cash. This is what the exact definition says. Ability of an asset to be easily converted into cash. But another thing, students, that in this case, what we mean by liquidity basically is that this money has to be kept aside. Now listen to me very carefully. This money has to be kept aside in case someone comes and make a claim of cash. I repeat, liquidity ratio, which is determined by the central bank, is the proportion of deposits that has to be kept aside by the commercial banks in case a depositor comes and they ask for cash, right? If they ask for cash. Now, let me show you one time and then you will be able to understand this better. So think about this. At the moment, let's say, at the moment, the central bank has said that the liquidity ratio has to be 50%. At the moment, the central bank has told all the commercial banks, I did tell you that liquidity ratio is not determined by the commercial banks. Liquidity ratio is dictated or instructed or suggested by the central bank, and all commercial banks in the country have to comply. There's no way they cannot comply. They have to comply, otherwise they can be subject to regulatory action. Legal action, and they cannot afford that, right? Now have a look at this, students, right? So let's say liquidity ratio is 50%. So how much would be the amount available to issue loans? If out of the total deposits, liquidity ratio determined, it's always in percentage because that makes life easier. So that is 50%. So how much would be the amount available to issue loans? Obviously the remaining 50%. Right? This is as simple as that, right? Because if liquidity ratio would have been 10%, so the remaining amount is available to issue loans, which would have been 90%, so 100 minus that amount, right? As simple as that, right? So 50% is your liquidity ratio, which means that this is the amount that banks cannot use to issue loans. The remaining amount is available to issue loans, right? So 50% is liquidity ratio, 50% is the amount available to issue loans. Easy? Are we good on this? Now think about this. Students, think about this. Now the formula for credit multiplier is, the multiplier word itself shows that you are multiplying. It's a multiple of something, right? So credit multiplier is basically 100 divided by liquidity ratio. 100 divided by liquidity ratio, right? So then that means, just a second. Okay, students, have a look at this. So if 100 divided by liquidity ratio, in this case would be how much? 2. Now this means that for the amount, 2 credit multiplier, this is how we calculate it. This is as simple as that. So formula is just, what is credit multiplier? So credit multiplier is calculated as 100 divided by liquidity ratio. Liquidity ratio would always be provided to you in the question. So all you have to do is that divide that number, 100 divided by that number, right? So you get the credit multiplier. In this case, it turns out to be 2. What the example that we're using, it turns out to be 2. Now, what does this 2 represent? That is the main question, right? Now, what does this 2 represent? Just like we talked about, multiplier effect in Keynesian cross, we did talk about it, that what that multiplier effect shows. In this case, the 2 credit multiplier shows that you can issue twice the amount. You can issue twice the amount, twice this amount in loans, right? So 2 credit multiplier means that the amount that is available to issue loans can be issued 2 times, right? Students, are you getting me? Right, obviously, Arbab. So when the question says how the credit multiplier, so if there is a question on the past paper that says explain the process of credit multiplier or how credit multiplier can be used to control money supply, which is the main question, right? Which we are coming to in a bit, right? Then obviously you have to mention the formula. Okay, so students, stay with me, right? So true credit multiplier means that you can issue 2 times the amount. You can issue 2 times the amount that is available to issue loans. You can issue 2 times the amount that is available to issue loans in loans to your customers, right? Now have a look at this. Out of 100 total deposits, what was the total deposits that we were assuming, right? So there's, let's get rid of this mess a little bit, right? So the total amount that was available to issue loans in the country, as per our example, was 100 billion rupees, right? Out of that 100 billion, 50 billion was not available because the liquidity ratio is 50%. So out of this 50%, 50 billion rupees were not available to issue loans, and the remaining were available to issue loans, right? Now the credit multiplier turns out to be 2, which means that you can issue 2 times the amount. You can issue 2 times the amount that is available to issue loans in loans, right? I repeat. So you can issue 2 times, the amount that is available to issue loans in loans, right? Which makes it how much? 100 billion rupees. So long story short, against 100 billion rupees of deposits, the bank was able to can make loans up to 100 billion rupees. Against 100 billion rupees of deposits, this bank, based on 50% liquidity ratio, can issue loans up to 100 billion rupees, which is exactly the same amount that you have in loans. If now quickly students, now let me give you an example, another small example to solve, because that will help you to better understand what we've done. So let's not change the amount. Of the deposits. Let's assume the amount of deposits is the same. One thing that I'm telling you, and based on that, you have to tell me what is the total amount that would be issued in loans, right? So let's assume the liquidity ratio suggested by the central bank is 25%. Now, what I want you to calculate, so this amount is given, the total amount of deposits that are there in the bank, and I've also mentioned how much is the liquidity ratio. Now, based on these two pieces of information, I want you to calculate the amount of loans that can be issued. What do I want you to calculate? Amount of loans that can be issued. Quickly, right? You know the formula, you know everything. Amount of loans that can be issued, right? That's what I want you to calculate, right? That is what you're supposed to calculate, right? Is it 150? Right? Let me do the maths. Let me do the maths here, right? So what you did was basically you divided 100 by 25. Why? Because that would give you the credit multiplier. So this turns out to be 100 divided by 25 turns out to be 4, right? So your credit multiplier is 4. Now you can issue 4 times, the amount that is available to issue loans, which turns out to be how much? 75. You did a little mistake, Arba. So that amount is 75 billion rupees. So 75 times 4 is 75 times 4 is how much, students? 300. 300. Arba, did you get me or not? Right? You made a small mistake over here. Think about this. Think about this. This amount you did not calculate correctly, right? So let's do it one more time so that we are absolutely clear, then we move forward, right? So the thing is that if 25% is your liquidity ratio, right? Right? This means that 25% of your deposits cannot be used. 25% of your deposits cannot be used to issue loans. So that means what is 25% of 100 billion? Obviously 25 billion. Easy, simple. And the remaining 75% can be used to issue loans. The remaining 75% can be used to issue loans. So what is the remaining amount that is available to issue loans? 75 billion rupees. 75 billion rupees. Is this simple? Is this simple, Arba? Now, when I do this formula, when I substitute 100 divided by 25, which is the liquidity ratio, it gives me a value of 4. It gives me a value of 4. Now, I can issue 4 times the amount that is available to issue loans in loans. So 75 times 4 gives you 300 billion rupees, which the banks can issue in loans. Now, from this example, what did you understand? Quickly, students, what did you understand from this example? That what is the relationship between liquidity ratio? What is the relationship between liquidity ratio and money supply? What is the relationship between liquidity ratio and money supply? Who can tell me? So what is the relationship between liquidity ratio and money supply? Right, anyone? Or just tell me, you are getting confused with the word money supply. What is the relationship between what is the relationship between liquidity ratio and amount of loans issued? What is the relationship between liquidity ratio and the amount of loans issued? Yeah, that's the question. What is the relationship between liquidity ratio and the amount of loans issued? Come on, that should be simple. We just saw that. We did an example with 50% liquidity ratio, and then we did an example with 25% liquidity ratio. In which case were the amount of loans issued more, right? Higher the loans, exactly. Wow, that's absolutely correct. The more the liquidity ratio, the less the money supply. Exactly. So you both said the same thing with different perspective. Yes, that's correct. Lower the liquidity ratio, lower the loans issued. Lower the liquidity ratio, higher the amount of loans that can be issued. Lower the liquidity, because think about this. Liquidity ratio is a constraint. Liquidity ratio is a constraint because if the central bank says that you have to maintain more liquidity ratio, you have to maintain more liquidity, right? Then you will not be able to issue much loans. Lower the liquidity ratio, higher the amount of loans issued. So if is there any confusion so far? Higher the amount of, so this is the rule that you need to always remember. And you also understood the calculation. Did you guys understand the calculation? Lower the liquidity ratio, higher the amount of loans, higher the amount of loans issued. As simple as that. Right? We got on this? Okay. So if there's any confusion about the calculation part or this thing, first kindly ask me. Right. Yeah, you are correct, Arba. So you just use the other way. So lower the liquidity, higher the loans. That is what I wrote on the board. Right, exactly. Isha also said the same thing, but from the other point of view. The more the liquidity, lower the loans issued, and lower the liquidity, more the loans issued. Both are correct, right? Okay, now students, here comes in the main part. Now you would have a basic question which I would like to address before we move forward. Now the question that you would have in your mind is that how is that even possible? So against 100 billion, so I'm talking about the recent example that we did. Against 100 billion rupees, how can this bank issue 300 right? Against 100 billion worth of deposits, how could this bank issue loans worth 300 billion rupees? Yes or no? In case it does, right? Because this is the maximum amount. So in some cases, might be issuing loans on this, right? So why I'm always using the word maximum amount? Now listen to this very carefully. Why am I saying that this is the maximum amount that you can issue? Because not all customers are credit worthy. Not all customers, businesses plus individuals who are coming to a bank to take a loan are credit worthy. So what happens, the normal procedure is, let me tell you, go to a bank and you apply for a loan. They ask you what reason you are applying for. You will tell you want to buy a car, house, blah blah blah. Then what they will do, they will ask for financial documents. They'll want proof that where are you living. Obviously they need surety some sort. Then they'll ask you how much is your salary, how much do you earn, how much are your expenses. They'll make you fill out different forms, and then there is a special department, credit assessment department in banks, that will evaluate your case and then decide whether the amount that you have requested for, so let's say if someone requested for 20 lakh rupees, but whether you can be given this much amount of loans. Are you enough? Are your financial strong? Are you credible enough to be issued this much loan? If they see that you're not, then they will not issue you 20 lakh rupees. They might issue something less, and in some cases they outrightly refuse the customer and they don't give any loan to that person, right? So there are different scenarios, but this is the maximum amount that the banks can issue. From interest, banks get from loans, right? From interest rates, sorry, right? So these are the loans on which the banks will charge interest. Yeah, so these are the loans on which the banks will charge interest, what we were talking about earlier. Yes, Arba. So this interest is what the banks will charge on the loans. Exactly, if they issue the loans. But is the process clear? So 300 billion doesn't mean that always the loan of this bank will be 3 billion. No, 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 no. This only means that it can be, the loans can be up to 300 billion. What are the other factors that they will consider? Other factors that they will consider includes whether a customer is trustworthy or not, and so on and so forth, right? So these are the other factors that you need to consider to decide whether someone is creditworthy or not, whether that person should be issued loans or not, right? Easy. Are we good on this, students? Are we clear on this? Is this making sense? Right? Okay, now we know the rule, know the liquidity ratio, high the amount of loans issued. Know the liquidity ratio, high the amount of loans issued. Now, how this process works, that is what I was about to explain you. Now, listen to this carefully. Not all customers, I have my savings in a bank, but what do I do when I need to buy something? Right? Nowadays, what is happening, students? What is happening and what is changing so rapidly that has changed us, that has changed how people use cash. Every time there is, let's say, I'll give you very simple example that you can relate to. I need to get credit for my phone. I don't go, to a shop, pay the cash, get the credit card. Oh, sorry, get the, card for my phone for the credit. No, I just open my laptop. I make an online transaction. I, input the credit. I buy the credit for my phone that I need. Similarly, if I have to make any, today my lawyer filed my tax return, right? I was talking about that. So I have made him online payment. I don't know where he is. He is somewhere in Islamabad, but we hardly meet. He just sends me a message, okay, the text file has been completed. I go to my bank online, banking app. I open there and I transfer him the money. He confirms, yes, he has received the money, right? So what I'm trying to say, this process stays in circulation because reliance on cash has been decreasing. Reliance on cash has been decreasing. So that is why even if you have less cash lying in a bank, banks can still issue loans worth more than that amount. Why? Because not a lot of people are not even using cash, right? So we'll continue from here in tomorrow's class. Students, class is about to expire. So I'll meet you tomorrow. I'll post the timings about the class and then we'll continue from here, right? So let's have a class tomorrow. And somewhat it would be around this time. Perhaps a little early, but sometime in the evening, right? We're good on this. So I'll see you tomorrow. And then we'll continue from here, right? Right? Easy? So yeah, so since cash reliance has been decreasing, that is why banks can issue amount of loans more than the deposits that they have. This is how it all works, right? So I'll see you tomorrow, right? And if there's any confusion, I'll clarify this first and then move forward from it, right? Okay, so take care. and have a good night.